Hello, welcome again to FAIRtax Power Radio. I'm Bob Paxton.
And I'm Bob Scarborough.
And we are the FAIRtax Guys. You
I love
see,
it.
I have been banished to exile on my little tropical island.
That's right. Say hello to Gilligan and Mary Ann for me.
Yeah, we'll do that. And the skipper and the professor and all those folks are doing.
Love you.
So I tell you what. Now, let me right off the bat encourage people who did not see the last two FAIRtax Power Radio episodes for whatever reason to go to our archive on Rumble or on our FAIRtax Guys YouTube channel. You got to get into the live section to see the shows that we've streamed. But what Steve Hayes and John Richardson were talking about the past 2 weeks here, Steve described one time, he wrote a chairman's report about this Moore case that they were talking about as the scariest chairman's report he has ever written. Because if the Supreme Court rules that the Congress and the IRS are indeed able to tax unrealized income, that would be like the appreciation on your asset, the equity in your home, stuff like that. They can tax it. If they rule that the IRS can tax that before you actually realize the gains, there is no limit to what the IRS could impute to somebody as income and just send them as big a tax bill as they want. This is, I say, it's not getting a lot of attention in the media, but this is a hugely, hugely important question that the Supreme Court's going to have to settle regarding what taxation in America is going to look like going forward. And I urge everyone to go back and brush up on this Moore versus United States case. And of course, you can't lobby the Supreme Court like you can't call your Supreme Court justice and tell him, hey, you need to decide this way, the way you can do with your representatives. But it's something that we need to be paying attention to. And if the court rules that taxing unrealized income is indeed constitutional, that might be another impetus to replace the entire system with a fair tax.
Well, and I don't know that it would actually accelerate that path to the fair tax, a tax on consumption. But when you think about it, you're only talking about gains on paper, which if enacted, if it is deemed by the Supreme Court to be something that can be done, that it is constitutional to tax unrealized gains, unrealized income, it disrupts the entire economic structure. And would have worldwide implications, not only for the particular debate there in Moore v. the United States, but I think you end up with a challenge for example, you live in your parents' house and they built and bought the house, back in the late 40s or 50s. If you're in, our generation, you end up with let's say the whole shooting match, construction of house, land, and all that was $10,000. Now you're sitting on a piece of property that is on the tax rolls at $450,000 or $600,000 or maybe more, depending on where you are. All of a sudden, you're going to get a knock on the door. Your mailman's going to deliver you the notice that says you now owe tax on the what's realized is the gain off of that. Does it go all the way back to the time of your parents? No, probably a little bit less time than that is what it'll end up being. So it's very important that we look into and that everybody stays focused on this particular instance that's coming before the Supreme Court that's in there now, and we feel that the fair tax, a tax on consumption, puts a stop to a considerable amount of that the shenanigans that are going on in terms of the Congress, the government's unrelenting effort to get as much money out of our pocket.
Yes, never, ever, ever underestimate a politician's lust for your money.
That's exactly right. That's exactly right. I just lost my light, so. While I turn my suntan oil back on, you continue with Congress.gov.
I will do that. We have spent the past 2 weeks
I'm going to be on the camera here working. So everybody's
Okay,
going
you're going to try to restore
I'll be
your
in a
lighting.
different light.
Okay.
I'll be in
Well,
a different
just
light. Yes. Stand
okay,
by.
everybody, just ignore what's going on the left side of the
Nothing
thing,
happening.
and
Pay no attention to the man behind the curtain.
let's go on to our Congress.gov segment. Say we have not been doing that for the past couple of weeks. We don't do that when we have guests, but Congress is back in session, and yep, they are back at it. So let's see what they come up to. Let's start with this one. S3037, a bill to amend the Internal Revenue Code to allow early childhood educators to take the educator expense deduction and for other purposes. Now, does that sound a little fishy? That they have to have a special provision in the tax code to allow a certain group of educators, early childhood educators, to take the educator expense deduction and, of course, for other purposes.
Of course.
Yeah.
I didn't even have to listen to that. I'll just remember for other purposes. So wait a minute, we have an option to do something else if we want to for this particular bill. Yeah.
All right. Well, we got a lot here. Let me go through it kind of quickly so don't burn up too much time on this one. Sure. S3020, a bill to amend the Internal Revenue Code to equalize the charitable mileage rate with the business travel rate, which means if you use your car for business, you keep track of how many miles you drive your car in the performance of your business, and you get to deduct so much per mile. And apparently, if you use your vehicle for a charitable purpose, this bill from Amy Klobuchar in Minnesota wants to say we're going to apply the same mileage rate to charitable use of your vehicle as with business use of your vehicle. And of course, you cannot have a tax code without that.
Of course not. And a lot of people don't take the itemized deductions. There are some people don't meet that threshold, which is what, $25,000 now that you get.
What about here? They're like almost 90% of taxpayers take the standard deduction now. So who knows? Let's go on. S3016, a bill to amend the Internal Revenue Code to repeal the clean vehicle credit. Now, how do you get the clean vehicle credit? Is that when you go out and wash your car every week? I was going to say,
show your receipt from Ajax car washing service. Yeah.
Oh, mercy. All right. And I'll tell you what, the number, what's the next one? There it is. This one is going to be in the Hall of Shame. Now, again, not because it is a shameful purpose. This thing actually makes a lot of sense, but it's insane that you have to put something like this into the tax code. So that is why this one, HR 5872, is going to make our 2023 tax proposal Hall of Shame, to amend the Internal Revenue Code to postpone tax deadlines and reimburse paid late fees for United States nationals who are unlawfully or wrongfully detained or held hostage abroad and for other purposes. Isn't it crazy? You have to put something into the tax code, because without it, the IRS could say, I don't care if you're in an Iranian jail somewhere, you still have to pay your taxes on time, or we're going to nail you with the penalties and interest.
So is the IRS agent going to go over and work his way through the penal system over there in whatever foreign country you might have to be incarcerated in, and say, hey, I need to see cellmate 24835-1.
But without this, I was just saying, without this provision, someone who hopefully we don't have very much of this happening at all, but if you're held hostage in a foreign country, or you're imprisoned over there in a foreign country, and you miss your tax filing deadline, and you say, well, I'm sorry, I was kind of tied up over there, and they say that's no excuse. Now, this at least gives them the excuse, makes that a valid excuse. So the fact that you have to put that into the tax code is most shameful. So this one goes in the Hall of Shame.
Great Scott.
Oh, mercy.
The Hall of Shame, do not pass go. Do not get taxed.
Okay, we'll leave our Congress.gov segment go right there. There's more stuff we will get into next week. But you sent another article that we found from the Brookings Institute. The title on it is, let's see, let me scroll back to the top. Proposed fair tax rate would add trillions to the deficit over 10 years. This was published in March of this year by William G. Gale and Kyle Pomerleau, Pomerleau. And first thing I did after reading the first couple of paragraphs of this article, I said, wait a minute, what is the political leaning of this Brookings Institute? And I looked it up, and I found that generally it leans left, but it has a pretty decent record for being factual. So I'll just leave that where it is. But let's read this first couple of paragraphs, because there's some stuff in here that is just plain not right. In a deal that secured Kevin McCarthy the speakership, again, this was written back in March, House Republicans plan to vote on the FAIRtax Act of 2023, H.R. 25, which would replace almost all federal taxes with a 23% national retail sales tax, create a family consumption allowance, a type of universal basic income, eliminate the IRS, and create a trigger to eliminate the sales tax if the 16th Amendment, which outlines Congress's authority to levy an income tax, if that's not repealed in 5 years. In a forthcoming study to be published in Tax Notes Federal, we analyzed the fair tax and find that the proposed tax rate is far too low to achieve its sponsor's stated goal of deficit neutrality. Now, there are lots of big targets that you can shoot at in that are just not right. I'll give you first shot. Go.
A national retail sales tax, creating a family consumption allowance type of universal basic income. No.
Ding, ding, ding. That's it. If I were trying to make the fair tax unpalatable to what is its perceived base of support right now, that's exactly what I do. I try to tell folks that are supporting, oh, look at this. This thing's got a universal basic income in it. And these Brookings Institute folks aren't the first people to say that. And they're just as wrong as the other group that we pointed out a while back here on this program.
Well, they understand universal basic income because that's what they want to drive into everybody's mailbox or bank account, so that you get a shelf of foundational coverage from the government. And of course, we know, and for those of you watching and listening, understand, if you've been on the program with us before, the quote family consumption allowance ain't what it's called. Number one, we call it a prebate. It's designed to reflect a number based on the people that are in your home, annual recalculation based on the poverty rate that is basically set on an annual basis by the federal government. And so your prebate is, if you got a family of 4, it's a certain amount. If you're 2 people in the house, it's a certain amount. But it's money that you would have spent in paying a fair tax on essential items that you determine what's essential up to the poverty level. And that's what.
There is a thing called the family consumption allowance in the fair tax bill. What that is the amount. It's basically your standard deduction. The income tax does not tax every dollar you make. You are allowed to deduct so much from what you get before you start paying taxes on what's left. And to implement that same idea on a sales tax, you have to say, all right, this amount of spending is going to be exempt from the tax. That's your family consumption allowance is your standard deduction. But since you can't keep track of everybody's spending as they spend, that's just logistically impossible. They say if the tax is included in the price of everything you buy, at least retail services and new products, that you're going to be paying this fair tax on every purchase you make, but you don't actually owe that fair tax until your spending exceeds the poverty level. So if they know what the poverty level for your household size is, i.e. what your family consumption allowance is, they take 23% of that and says, that's how much tax you're going to pay on that level of spending. We're going to give that back to you so it doesn't come out of your own pocket until your spending rises above your family consumption allowance, i.e. your poverty level. So again, the prebate is what we call it, a rebate given in advance. We give you back the taxes that were collected from you that you don't owe. And that is not any different at all than the tax refund you currently get from the IRS if your withholding exceeds your tax liability. If more is taken from you than you owe, you get back what you didn't owe. And that's the same way that this prebate works. It is not a universal basic income. It is a tax refund of your money that you were paid at the cash register that you did not owe. And the people that are trying to portray the prebate as a universal basic income are pretty much, they're trying to drive a wedge between the fair tax and its base of support. And that's just hopefully not going to work.
Well, and to go on in the article at Brookings.edu, it was penned by a couple of writers back in March. And it was at a time where HR 25 was in the news a lot because it was a component of former Speaker McCarthy's promise to his delegates and then to the people that are in Congress with him, that if you let me be Speaker, then I'll promise to bring HR 25 to the floor for debate and a vote, which was something I'm expecting.
Now that McCarthy is no longer there, we'll have to see if that vote actually takes place. So, little side note here: we encourage everyone watching the program to lean on your representative and make sure that even though the speaker that made that promise is no longer speaker, that the promise is still good, and the Congress actually will, or the House of Representatives anyway, will actually vote on the fair tax as former Speaker McCarthy promised they would.
I think that could, based on the number of people we know that are in the House of Representatives that support the fair tax and stood that HR 25 up as a hurdle for McCarthy to get over, that they would continue to consider that as a prerequisite for whoever the person is that's basically brought before a vote for the Speaker's position. Now, all right. Well, interestingly enough, if you want to continue in this article, I find a couple of things interesting, and especially
this may be just an honest error, but I would think that people hanging around Washington, D.C., who are a policy think tank would know better, know what the Constitution says. They're talking about if the 16th Amendment is not repealed, they say in 5 years. That's actually 7. So that's kind of a minor point, but that always casts a little bit of a shadow on their shadow of doubt on the credibility of the folks who do this to know what they're talking about. But this is what really hit me when it says, in a forthcoming study to be published in Tax Notes Federal, we analyzed the fair tax and find the proposed tax rate is far too low to achieve its sponsor's stated goal of deficit neutrality. No, there never has been a stated goal of deficit neutrality. It's been revenue neutrality. The fact that we are going into debt head over heels, we're spending a lot more money than the income tax is bringing in. The fair tax was designed to bring in the same amount of money as the income tax, which currently is woefully insufficient to meet all the spending that we're doing. But the fair tax can meet revenue neutrality. So we're not trying to knock out the deficit with a fair tax. Hopefully the economic growth that the fair tax would spur would help in that regard. But the design goal, goal of the fair tax is not deficit neutrality. It is revenue neutrality. That is a huge mistake. Again, I don't know if that's a mistake or if that's just intentionally misrepresenting what the fair tax is stated to do.
Could be, but I mean, you scan through articles, and this is about a 5-minute read on Brookings.edu, but I think that folks read a paragraph or two and they go, oh, well, it's kind of, it's economics. People are kind of go to sleep when they start looking at numbers and things. But the challenge in the words like deficit as opposed to revenue in that statement that they made obviously sends a thinking individual, if this is all they're looking at, down the wrong path of what the fair tax actually is attempting to do. We have to present something that is revenue neutral. There's no other way around it. Everything's got to. So consider the fact that it's economists and not politicians that are coming up with this over the last 20 plus years and spent a lot of money, millions and millions of dollars spent on bringing about what the fair tax is. You talk about the amount of money that you collect. We have to collect the same amount of money now. And then, of course, the debate shifts over to, how do we curb spending? But something else that when I read this article came into play in my mind was, are these writers and the study people at Brookings, are they thinking about the fact that we are opening the gates for a million and a half more consumers that would be added to the act of paying a tax, the tax on consumption, the fair tax? Are they thinking about 155 million taxpayers to 200 and some million consumers that would be contributing to the Treasury through the fair tax? I don't know that they are. I didn't see it anywhere in the article. Did you?
I didn't, but I did see this where it says farther down, it says, of course, no tax is free of evasion or avoidance, and the fair tax offers ample opportunities for both, as if the income tax doesn't. High rate retail sales taxes are difficult to administer. I don't think that they'd be any different, just the numbers are different from the sales taxes that they're already getting because there's no third-party reporting. You skip down a little bit. If one assumes that the fair tax would generate the same 17% rate of evasion as the income tax, the required tax-inclusive rates rise to 34.1% or a 51.7% markup at the cash register. Now, who in their right mind is going to believe that a consumption tax that is part of the price of everything you buy will be evaded at anywhere near the same rate as an income tax, which is dependent upon you truthfully telling the government how much money you made, and again, truthfully claiming only those credits and deductions that you're rightfully entitled to, that nobody fudges that on either side. The assumption that the fair tax will generate the same 17% rate of evasion as the income tax is just absolutely ludicrous on its face.
And I think folks that are in think tanks and everywhere, they sort of debate and have conversations, and they're in a vacuum of their own design. They don't sit around a table with folks who may have a different opinion about what they're looking at. And as you said, Brookings, a little left leaning. We're apolitical. FAIRtax is not on either side of the political spectrum. We are simply about a different way of collecting revenue for the Treasury, for the operation of the federal government. But I do believe that sometimes if you sit around the table with the same people all the time, you're going to end up coming up with, oh yeah, that sounds really good. Yeah, we believe this. Yeah, we think this is going to be right. But they don't have anybody to go, wait a minute, y'all are knuckleheads for thinking this, which is sort of what we're doing here. We're sort of after the fact, way after the fact in this particular article, saying, hey, these things are not, I can see where you might get that, but you're not in the right, you're not even in the ballpark when it comes to evasion. We know that there is considerable, a considerably less chance of that. A lot of it due to the fact that with the fair tax, you have to have two people in order to avoid or evade paying the tax. Today, tax is just you. Maybe you're
It takes the cheater and an accomplice at the store that you're buying something from to illegally evade the fair tax. All it takes is somebody well versed in creative accounting to fudge on their income tax.
Well, and the other side of it is the real position of states. And I had this conversation with somebody on X, formerly known as Twitter, not too long ago, about the how you would consume, how you transfer the money from the register at the store to the state to the Treasury. And it's a very simple process. But the gentleman brought up an interesting point, and that was that if you are a state that doesn't have a state sales tax, are you going to be inclined to handle that as a business? Are you going to be inclined, a retail business, are you going to be inclined to handle that transaction? And I said, well, yes, they will, because they're going to get a small piece of that transaction to pay for. So it's another line of income for them, depending on the volume of business. They could be considerable. If not, it's an amount. The same happens at the state level, sending it on up to the Treasury. So we have to keep those things in mind. They're not necessarily going to be, the business isn't necessarily going to be trying to pull any shenanigans, because the state's going to find out at some level.
Well, also the FAIRtax, the administration and actual nuts and bolts working of it will be incorporated into all of the point of sale software that businesses use. So even if your point of sale software is currently not collecting a state sales tax, you can have the FAIRtax programmed into that. The business doesn't have to do anything other than implement the updated version of their point of sale software that includes the FAIRtax. One other thing I wanted to get to in this article before we run out of time, we got a little less than 2 minutes left. It says many of the other purported benefits of the FAIRtax are overstated or illusory. The amount that the FAIRtax would reduce complexity in the tax code would be limited if states and localities keep their income taxes. Now, that's partially true, because the FAIRtax does not replace state level or local level income taxes. I don't know of any localities that impose an income tax, but most states do. But to think that the FAIRtax is really not going to reduce complexity all that much. Again, look at the income tax code, 70,000 plus pages of statutes and case law and the regulations and stuff like that, versus 130 pages of FAIRtax bill. Again, comparing the complexity of the income tax and the FAIRtax is like comparing a Boeing 757 to a clothespin. I mean, it's just, it's not even close.
I mean, but the other side of it too is again, folks are throwing up, and this is again a revered thinking institution, Brookings, and they're in how much research did they do on this? I don't know, outside of talking to themselves and maybe going to their regular places that they go to for these types of analyses. But to say that you're getting rid, here we go, you're getting rid of publication 17, which is form after connectivity between the form, and make sure that if you borrowed, stole, otherwise used your neighbor's lawnmower and didn't return it in the same year that took it, you have to consider that to be use value, and you have to put it on your tax return. The same for people selling drugs or anything else. They've got to put their income in. I mean, this type of insanity gets knocked out completely. It's gone. Zero.
Absolutely. And I'll tell you what else is gone. Our time. We are completely out of it here for this edition of FAIRtax Power Radio. So again, we would direct people that would like to read the entire article to the Brookings website and check that out. It was published in March. But that's going to wrap up this edition of FAIRtax Power Radio. Thank you again so much for watching, listening, and sharing these videos. I'm Bob Paxton.
Bob Scarborough.
We are the FAIRtax Guys, reminding you the FAIRtax is the only truly fair tax, and once you understand it,
you'll demand it.
So tell me, how could I pay less taxes?
Less?
Yeah, I'm trying to get ahead, so how can I pay less?
Well, I suppose you could pay less taxes by earning less money, or you could give to charity.
How is that going to help?
Actually, I'm not supposed to tell you this, but if you know the right people, okay, or if you have a really good lawyer, you can usually get around the big ones.
If I may, under the FAIRtax, to pay less taxes, you would simply consume less. You would control how much you pay and when you pay your taxes simply by choosing what you purchase and when you purchase something.
So I could stay